Hi, this is Parag Sam with this episode of the Live and Work Abroad show. Thank you for joining us live on FaceTime, Facebook. You can also view us. We have a channel, Living Working Abroad, on YouTube and Twitter, as well as FaceTime. Want to contact us? You can contact us at productpartnership.com. We're looking forward to the Halloween budget this month from the UK. How will that affect people with UK tax returns, UK expats and UK expats living and working abroad, as well as expats living and working inside in the UK for what your liability might be there. There's a whole range of things that could be affected, and we want to summarise those now. Obviously, we cannot predict exactly what's going to happen in the budget. So for more information and guidance on what your tax liabilities might be as an expat, as an investor in the UK property and business and investments, contact us at productpartnership.com. So let's have a look at that. Income tax is really, really easy one to pick up on. It's one that's been attacked over the years. We've had, in effect, 20 years of governments that have had very much a tax-raising agenda, whether that's the Labour Party or the Conservatives. And now it's going to the next level. This so-called black hole already existed. It's about balancing the books, and that's what it needs to do. So if you've got a government that's committed to increasing spending, then they need to raise taxes, and they need to raise taxes in such a way so we don't get a stampede on the money markets to undermine what is being done. So you can only spend more money as a government, you can only spend more money from the national purse if you tax the people that are working for that money. Now, what the Labour government have already committed to is not to increase income taxes, VAT, and national insurance on working people, whatever that may be. Everybody works someday in their life, whether you're working to bring up your family, whether you're working to build up a business, or whether you're working in a job, you are working, whether it's a public servant or in private industry. And that work generates income which is taxed. Then with that taxed income, you then save. You invest in property, you invest in savings and investments, invest in a pension plan, but also you might build up your own business and create a capital value from that. Out of your taxed income, you save and create a capital value, which is a great thing to do, and it's an aspiration for us all to do that. And if we're successful, we can do very well. 60 years ago, in 1964, the Labour government then introduced capital gains tax at a very benign lower rate, but it was a new tax. So your taxed income, which you'd use to invest in your wealth, was then taxed some more when you sold or disposed or when you died. And here we are today. And if the income taxes and the VAT are committed not to be changed, and that raises 75% of the taxes in the UK, then what's going to be changed? The additional money that they're going to raise is going to come from capital taxes and some other adjustments to allowances that will be affected and will be a bit more discreet, so they can't be attributed to working people. It might be people who have built up an investment fund, might be people who have built up an investment portfolio or property rental portfolio in the UK or outside the UK. But whatever you've done to build value for you and your family across border and down generations is likely to be taxed to raise additional money that the UK need by adjusting the allowances, the exemptions, and the way the different things are taxed. So let's consider what some of the options are. In the Halloween budget, we may find that income tax allowances are frozen. They've already been frozen for years, and what this is gradually brings it brings people into the tax net, so that more and more people have their basic incomes taxed. And we can almost see now that the UK's basic state pension, for example, is equivalent to the personal allowance. So anybody that is a retired pensioner and not working has got a state pension, which is more or less the same as a personal allowance. So any more income that they're going to get is potentially a taxable income, because those allowances haven't been increased by inflation over the years. So that's very possible and very easy for them to freeze that regime. So we've got it frozen already for until 2028. The last Conservative government already did that. So why not keep it for the whole of your parliament, that you can freeze those thresholds, which does the maths as far as the GDP and the money markets are concerned, to ensure that you can continue to raise more tax. And now, if you're earning over 50,000 income in the UK, you're on a higher rate tax, and then you've got the additional allowance, the additional tax rate at 45% over 125. And once you get over 100,000, you start to lose your personal allowance. So there's a migration between 40 and 45%, 100, 125. Very easy to clean that up, make that simple, and don't change the rate. But you know, if you're going to allow a personal allowance, allow it or don't allow it. So instead of having a graduated reduction of that personal allowance, why not just stop people at 100,000 getting a personal allowance instead of 125? Now, it's a change of an allowance, not a change of a tax rate. So it's something that we could push through, and means that more people are paying more tax at 45% once they get over the 100,000 mark. So bringing the personal allowance rates and the taxable bands into alignment, reducing and clarifying what the personal allowance is, and in effect it makes sense and it's logical that why not make the UK state pension equivalent to the personal allowance and keep it at that now that the inflation indexing of the pensions and the frozen of the personal allowance, now that that's brought them into line, why not keep them into line so that the personal allowance is always the same as a basic state pension. So basic state pensioners will not get taxed on their state pension, however, get taxed on everything else. There's also allowances for capital gains tax. There's allowances for savings taxes and dividends as well. They've been dramatically reduced over the last few years. Why not get rid of those altogether? A dividend tax and the savings tax is not on working people, so you could remove the remaining allowances on interest that's received from savings and investments and gilts, or dividends from a shared portfolio. Again, an easy way to increase that. Capital gains has already radically been reduced. We'll talk about more of that later, but again, why not get rid of the remaining £3,000 of personal allowance on capital gains tax? If your savings, when you earn savings, that they are all taxed in the UK, that interest at your basic rate or your income tax rates. Interest on savings is a movable income. Dividends at the moment is a movable income. So if you've got interest or dividends earned in the UK, but you're an expat living and working abroad, they are taxed abroad in your home country. So if you're an expat living in Europe and you pay, you receive dividends and interest from a UK bank or a UK share portfolio, then that's taxed in your home country, where you may pay 0% tax, as opposed to the UK, where you could pay up to 45% on the additional interest or 39% on dividends. So again, big opportunity there to simplify that. The dividend taxes, instead of being separate to income taxes, could be aligned the same as savings. So instead of paying dividend tax rates of 8, 33 or 39%, it's aligned to income tax rates of 20, 40 and 45. So not change the rates, not change the income tax rates, but change the dividend tax rates, and in effect double the dividend tax that you can charge at a basic rate from 8 to 20%, which will only affect people working from a personal service company or with an investment portfolio. So business people and investors will be the only people affected, not working people. And the marginal increases in the higher and additional tax rates on those dividends would bring in a bit of extra revenue as well. So instead of 33, it's raised to 40. Instead of 39, it's raised to 45. Potential tax changes by simplifying tax, so it's clear and simple for everybody to understand, but it'll raise more savings taxes. So the savings that you've created after the product of your work and investment over the years will then become a source of additional tax for the UK government. If you want more information and guidance on how an expat's savings interest is impacted by the changes in the Halloween budget and how an expat can protect their savings and investment from UK taxes, contact us at ProAtePartnership.com. Dividend taxes in the UK from a UK share portfolio are currently around 8, 33 and 39%. If they are changed and aligned, like with savings interest, into income tax rates of 20, 40 and 45%, then expats could face a significant potential increase, or UK taxpayers could pay a significant extra increase in the tax on those dividends. The dividends at the moment are movable. They're movable. They move with you. So if you're a UK expat and you move abroad and you leave a dividend portfolio or investment portfolio in the UK, then relocating overseas means that income can go with you, and you could pay as little as 0% tax on dividends and interest. So that's a big opportunity for expats living or working abroad, and one that you could take advantage of unless the budget chooses to adopt at the start of a 5-year parliament a similar approach to what our friends in America do. So in America and Canada, many more sources of income are fixed and taxed in the UK first rather than abroad. So despite the fact that you're having a double taxation treaty abroad, if you tax the dividend and the savings tax in the UK first, still allows your country of residence to receive their maximum amount of tax rate, but you could change it so that you're going to pay the maximum UK tax rate as well. Works in America where the tax rates are relatively low, but in high tax Britain, it could mean that an expat could still have their dividends and interest drawn into UK high rate taxes. For more information and guidance on how to protect your capital and income and investments from higher UK tax rates while living and working abroad, contact us at ProAtePartnership.com. There are some other tax allowances that could be changed in the budget, such as private equity profits for investment companies, such as fuel duties, that are more likely to affect people that are UK based. If you're an expat in the UK, you can't avoid necessarily additional fuel duties on the income that you're paying. But if you're running a private equity portfolio and the tax laws change, there's a big business decision to be made about how you're going to move forward with your business in the future. If we need more help and guidance in relocating your business overseas, contact us at ProAtePartnership.com. partnership.com. 'Cause 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 ' Another way that expats may be attacked in the budget is pension reliefs. Now, at the moment, if you've got UK income, you can put money into pensions and get um, income tax reliefs. And those income tax reliefs could easily be changed and disallowed. If they're reduced down to 20%, then the tax relief on pension contribution for an expat living working abroad is going to increase. So what are the alternative ways that an expat living and working abroad could reduce their amount of tax they're going to pay while providing for their pension in retirement? For more information and guidance on investment and savings for retirement, contact us at poetpartnership.com. With pension relief, as well as with capital gains tax relief, there's a great scope to clarify the reliefs and clarify the opportunities. With capital gains tax, there's a basic and a higher rate tax of 10 and 20%, but for a residential property, it's 18 and 24%. And so it becomes complicated. And there's additional allowances for those capital gains. Now, Labour introduced capital gains tax 60 years ago in 1964. So what can they do in 2024 on the anniversary, the 60th anniversary of capital gains tax? But why not make it and align it to simplify the tax system along the lines of the income tax rates? Very, very simple to do. Now, effectively, it would mean almost doubling the tax rate. They may not go that far, but they could do. So at the moment, you've got a basic rate capital gains tax, so basic rate taxpayers. Okay? So you take your income and you add your capital gain. If you're still considered your total income is below a basic rate, you pay basic rate capital gains tax. If you're then considered to be a high rate taxpayer, you would pay the high rate of capital gains tax. Now does that sound confusing? It could be, and so why not simplify it? Why not say that all capital gains are added to your income and taxed as income? And that would then take basic investments at a 10% or 20% high rate and put it into the income tax model. Not only would that mean that you get capital gains tax at 20 or 40%, but it also means that you potentially get additional rate tax at 45% on your capital gain. Think about it. If you're selling a property and you made 100,000, that immediately makes you a high rate taxpayer. If you're selling a property that you've held for 10 years and you made 200,000, that immediately makes you an additional income tax rate payer if capital gains tax is aligned and added to your income to work out your total income tax liability. So it's a distinct possibility. It would simplify what is already an overcomplicated capital gains tax system. So private residence relief was introduced to confirm the status that you can own your personal home and be capital gains tax free. But residential property capital gains tax is much higher than investment capital gains tax. So we've got 10 or 20 for investment capital gains, 18 or 24 for residential property. So why not align them all at 18 and 24? Or why not make the basic rate capital gains 20% for everybody? So it's simple. Income tax is 20%, a capital gains tax on investment and property is both 20%. Now, whether they go the whole hog to jump the capital gains for high rate taxpayers to 40% is a stretch, but they would defend it, saying it's simple, and the people who are paying this additional tax are people that are wealthy enough to do it. It's the rich. They're committed to taxing the rich. So if you made money from your taxed income to invest it in property or business or investment, and you pay that and you make that money, you realise it, and you try to pay that to your to get that benefit to pay to your children, whether they're in the UK or living and working abroad. Why not tax that to follow through at your highest margin rate? Very, very likely, very likely. Sorry, somebody just sent me a message and it popped up. The producer, thank you for that. It's very likely that capital gains tax will be increased because the taxes that are committed to not increase, VAT, income taxes, national insurance, are 75% of the tax take. So they've got to get the whole 40 billion from capital taxes. So capital gains tax could well be increased to protect your property, business and investments from UK taxation. Contact us at proactpartnership.com. Inheritance tax. Nobody alive ever pays inheritance tax in the UK. Why? Because you're dead. Inheritance tax is chargeable on your estate, so you're dead. And therefore, you may not wish to be that concerned about it. However, you may not want your life's savings, your life's wealth that you created to be taxed. You may want your children to benefit. You may want the house not to be forced sold to pay 40% inheritance tax. You may want the business to be able to continue without paying a 40% inheritance tax. You may want the investments portfolio to be retained without a forced sale to pay the inheritance tax due within 6 months of death on a worldwide estate. So it's a big issue. But again, inheritance tax is a capital gains tax, and it's not working people that are paying it. It's dead people. It's the estates of dead people that are paying it. So there's a big potential for them to refine and consider inheritance tax rules and refine them. Now, is the 40% inheritance tax rate going to go up? I would estimate 100% no, because it's already at the higher rate of the taxes in the UK. You're getting a high rate tax, capital gains tax, when you die. Inheritance tax is a capital gains tax. So going back to our capital gains tax argument, why not make the higher rate of capital gains tax 40%? Inheritance tax is already that rate. So if I want to simplify inheritance and capital gains taxes with income taxes, I use the 40% rate because it's already there. It's simple. So I'm simplifying the tax system and not taxing working people, because working people are alive and kicking and not dead and buried. So for more information and guidance on protecting your family, business, property and investments from inheritance taxes on death, contact us at proactpartnership.com. Let's just have a bit of a deeper dive into inheritance taxes, because there's actually more that could be changed as well. You've got a fairly big allowance of £325,000 per person, but that's been frozen in the UK for a long time. And in some parts of the country, you can't get a starter home for £325,000. So let's look at some of the reliefs. So the 325, it's not going to change. Nobody has seen the inheritance tax allowance change in the last 10 years. What was changed is that a family was given a private residence relief, an additional 175,000 to make £500,000 of inheritance tax relief. So if your principal private residence is in the UK, then you could potentially get an additional £175,000 of inheritance tax relief in the UK, making a total of £500,000. But if you're a UK expat living and working abroad, you've got a property in the UK, if it's rented out, it's going to suffer inheritance tax, no principal private residence relief. Even if it's not, even if it's kept empty, the UK have got they've got the claw into you, because if you own a property that you just keep as your home when you're in the UK, there's this great danger that they could use it to argue that you saw yourself as being from the UK, therefore they've got more tax to pay. But the fact that you're not living in your permanent residence because your tax residence, your country of tax residence, if you're an expat living and working abroad, and your country of tax residence is abroad, then you're saying that your permanent residence is not in the UK. Therefore, the property that you're in, how can it be your principal private residence qualifying for capital gains tax relief if your permanent residence for income tax is abroad? So again, very simple clarification of the law to mean that if you're an expat living or working abroad, you can't own a property in the UK and get the principal private residence relief. And which would mean that a lot of expats maintaining two homes and their holiday home being in the UK, because they're UK domiciled, they're still going to get inheritance tax at the full rate on the empty property as well, that they use as their UK holiday home. So a big opportunity for the Halloween budget to charge that additional tax or disallow that personal private residence relief, either for expats only or for non-doms only or for all people, just to bring it back down to 325 and allow that extra 40% on the residential property sale. That, of course, would mean that the family would be able to sell the property on the death of the parents and get the principal private residence if they sell the property on a forced sale within 9 months of the death to avoid the inheritance tax. But you'd still get caught up one way or another. There are ways to protect yourself from inheritance tax. For more information and guidance, contact us at proactpartnership.com. At Proact Partnership, we know how to protect your overseas property investments and business from UK inheritance taxes. If you're a UK domicile, then you're liable to inheritance tax on your worldwide capital of investments, property and business on death. If you're in the UK as an expat, after 15 years at the moment, you're considered to be domiciled in the UK. That legislation is changing so that after 4 years, you're considered UK domicile. So after 4 years in the UK, an expat is considered to be domiciled and therefore liable to inheritance tax on their worldwide income. That is not a tax raising trick of the current Labour government, although they did propose it. The last Tory government implemented that rule. So non-doms have already got this 4-year clock ticking about this potential loss of their non-dom status after 4 years instead of 15. When you're domiciled to the UK, then you're liable for inheritance tax on your worldwide income. When you leave the UK, you can't get rid of your UK domicile that easily because you're from the UK, your parents are from the UK, your family history is from the UK. So potentially using exchange of information in your probate administration, your property sales, your business sales around the world, the UK can potentially still come back to you for inheritance tax. Now, if you lived and worked abroad for 30 years, you can avoid that. But the day that you go back to the UK, you confirm that you're domiciled back in the UK. And to be clear, the case law on domicile is very, very clear. There is one piece of case law where somebody put in their will that after their death in Monaco, they want to be buried back in the UK, which they were, and that was deemed to be, therefore, that he was deemed domiciled in the UK and charged inheritance tax on his worldwide assets. There's even instances where, in case law, where cremation overseas and the ashes returned to the UK have been deemed to be confirmation that they saw themselves as coming from the UK. They've got a UK domicile, you're liable for inheritance tax on your worldwide assets. Exchange of information, whether it's a property sale, a probate administration, a bank account, a saving, a business, any form of levy that you're paying, any residency permit, everybody that's taking your tax number, your ID number, your passport number, your utility address is confirming and exchanging that information under law from the tax authorities about where you are and where you are. When you travel across a border, the airline has got your ID and the fingerprints and facial ID. They know that you crossed the border. So all those records are there, and you've got that potential liability to inheritance tax. So for UK expats living and working abroad, what can you do? You could trust your family. Create a family trust to hold your family assets, and the gifts into that trust can be potentially tax-free. And if you use the right type of international family trust, you're going to generate no additional taxes. And it's not always that you can protect yourself from taxes at source. So UK property rental is taxable in the UK. It's a fixed income in the UK, so you're not going to avoid that. But you can't avoid fixed taxes in another jurisdiction. However, you can create a family trust with no additional taxes. In the UK, you may have additional taxes on a UK-based trust, but an international trust for expats need have no additional tax. So you can manage your assets within the portfolio to protect yourself from tax and inheritance tax by holding your family property, business, investments and assets inside a family trust, which also has the bonus of avoiding the cost and delay of probate. And for more information and guidance on creating a family trust, contact us at proratepartnership.com. We've covered a lot today in the Living and Working Abroad show. We're fearful of the Halloween budget. We're fearful of the tax creep that's coming along. It's been happening for 20 years under successive Labour governments and Conservative governments in the UK, and a great opportunity with a massive majority for the current government to simplify the tax system and bring in some additional taxes. They're committed to publicly filling a black hole, and they can only fill that from capital and inheritance taxes and adjusting allowances and margins. That will affect expats as well as people living and working in the UK, expats and residents. Your tax domicile, your birth certificate, your family, where you're from, ties you to the UK and ties your tax liability. So you can manage that process, whether you're a non-dom in the UK or non-dom abroad, you can manage that process to protect your taxes. Follow us at the Living and Working Abroad show next week on budget day around this time. We will be looking at a live show to give you some direct commentary online about changes for that. We'll try and get some commentary from some experts as well, but you can get some expat advice with us in the Living and Working Abroad studio on the current, as the budget's announced, what the likely impact of that is. It's a scary time. We're looking forward to Halloween as well at the end of next week, but let's look forward to the budget first. And if you've got actions that you want to take now, or at least consider those, contact us at proratepartnership.com. But better still, contact us after the budget if you feel that your business, property or investments are going to be, or pensions are going to be adversely affected by the Halloween budget going forward. We're here to help. Contact us at proratepartnership.com. Thanks a lot for listening, and we'll see you again next time.